There's more people looking to invest in retail than there has been in a very long time.
What types of tenants are you calling day one that you think will be a good fit?
One subsector that we're going with a ton is cell phone companies. Those companies have been super focused on getting as much of that market share as possible. A lot of these buyers are either familiar with the asset class or they live within, 100 miles. And so it's close enough and they get it and they can buy it what I think is a low cap rate, but to them it's a high cap rate compared to buying inside of the larger metro that they're in.
The track record you mentioned is extremely impressive. 2.6 million square feet, 100 properties. From the first property to today, did you raise investor capital for each deal?
Yes.
And that was through you mentioned the fund and now the REIT, is that correct?
Yeah, well, so we bought our first Walmart shadow in 2015, and every one of those that we bought were in syndications until we launched our fund in Q4 of 2020. So we did a lot of syndications before that. A few of them had a few properties in them because the timing lined up the right way. But it was syndications. Then we did our fund, and the fund ended up being such a big pipeline in the beginning that we raised the money and closed it. We had a big portfolio that came together right kind of as the fund was launching. Same thing happened with the REIT. And so, to kind of put it in perspective, we were probably 30, maybe just less of 30 properties in the portfolio when we started the fund at the very end of 2020. And by June of 2022, so just over 18 months, we were at 100. And that was a wild time for sure. And a lot of, just how are we going to raise that money? How's it going to come together? A lot of scrambling at the final moments every step of the way. I still, to this day, we have never had more capital than pipeline. I hope one day that changes, but at the same time, I'd rather it be that way than the opposite. But that's just part of that journey.
Do you think you're going to see more deals coming your way in the coming months?
Yeah, I can't time it. We're seeing a lot of unique deals right now that we hadn't been seeing. Some of them, a lot of them still don't make sense, and we've been really diligent on not even buying just stable deals, that may be more stabilized, that take more time to add value. We've been pretty much holding out for the right combination of value add and lower prices and higher cap rates. We've only bought about 3 properties this year, which is very different than obviously the prior several years. And it hasn't been a complete switch yet. We've been selling properties. Part of our whole thing is we buy a lot of small deals. Our average deal is about $4 million when we buy it, at least. And so what we're seeing on the market right now is we've been selling assets, especially seasoned assets, where we've maximized, value creation, all that kind of stuff, and being able to sell those individually to what appears to me to be a wider buyer pool than I've seen in the asset class. But primarily it's, individual investors, people in 1031s, where that price point makes sense and they're still paying, cap rates at or below our projections. And so while that's still going on, we're taking advantage of that. But on the flip side, that's why we still haven't seen it kind of flip to a buyer's market completely in our asset class. But there is, we've been doing this so long, we know some, all the portfolios and all the history there. So we know when some debt's coming due. We know some things on the horizon that I think we're working on getting in front of and making sure that we have the capital ready to deploy. And what I believe will be the next 3 years will be the best buying opportunities that we're going to have, both in scale and in pricing. Is that in 3 months, 6 months? I don't know exactly, but I don't see rates going down significantly over the next couple of years. And so that just inherently is going to force a lot of people to most likely look at selling when their loans come due.
You mentioned that the buyer pool is a little wider, or it appears to be wider than when you guys were buying a lot of the assets that you own. Do you think that is in part due to the fact that you've professionalized the systems and operations for each property? You brought in perhaps better tenants or extended the lease terms, and now it's more palatable to a more hands-off owner versus you stacked a few different challenges to your acquisitions. It's small towns, it's deals that are perhaps mismanaged, deals that, maybe have occupancy challenges. Do you think that's what is attributed to the wider buyer pool when you go to exit these assets? Or is it just that these retail centers are becoming more and more popular amongst investors?
I would equate it most to, I think there's more people looking to invest in retail than there has been in a very long time. From an individual property standpoint, obviously, us having a lot more national credit, most importantly, national credit that's going to be viable long term. So a lot more services, less soft goods, that sort of stuff, longer leases, that all helps, especially in the pricing that we're trying to get. But at the end of the day, the wider buyer pool is not because it's, as much as I would like to say we're there yet, it's not because we've professionalized it. It's that there's a lot more data, around small towns. That's one of the reasons why there's a lot more tenants looking at small towns, but it's easier to underwrite a small town. And I think it's just a lot more people are looking at retail right now. And a lot of these buyers are either familiar with the asset class or they live within 100 miles. And so it's close enough and they get it and they can buy it at what I think is a low cap rate, but to them it's a high cap rate compared to buying inside of the larger metro that they're in.
That makes sense. So you mentioned the tenants that are looking at small towns more than maybe previous years due to the data that's available. If you were to buy a 100% vacant retail center that fits your strategy, if you don't want to give names, don't give names. But what types of tenants are you calling day one that you think will be a good fit?
One subsector that we're going with a ton is cell phone companies. T-Mobile, AT&T, some Verizon, but the demand and need for specifically 5G in rural America is gigantic. Those companies have been super focused on getting as much of that market share as possible. And a lot of it follows their infrastructure pipeline. So if they can get a new tower up, then they're going to make sure that there's a new store there. So it's a perfect example of kind of still national credit. So we buy stuff with national credit, but we might replace it with different national credit. But this national credit is serving a need that's really important today and will continue to be important. They're paying market rents as we describe them. And, it's kind of how these strip centers, both in our towns, neighborhood strip centers, one of, I think, the appeals of a strip center, and one thing to really make clear, I think, is that when I say strip center, it's not, a big junior box where you have 20,000 square foot box that was built for one tenant and a 15,000 for another, and all these different misshaped sort of shopping centers. It's traditionally, 120 feet of depth and very simple comparatively to split those spaces up, change, alter them, and evolve the tenant base alongside, the needs of the consumer of that area. And so for us, it's always what are those needs today, and what also is that tenant base look like that's going to do the same or better in a downturn, or if they do worse, is it significantly worse, or is it just maybe a little bit worse? And so a T-Mobile, AT&T, those types of guys we grow with a lot. Great Clips, financial services, including insurance, financial advisors, all those sort of things. Dollar Tree is our largest tenant. Transparently, we don't put them into a lot of new centers, but they're a huge anchor of ours and the ones that we buy where they exist. And, a unique story is, some tenants that are growing in small towns that I never would have anticipated that we'd be doing as many deals as we are with is for example, Five Below. And, one of the really cool things about our experience with them specifically, and I think is a testament to also the evolving mindset of retailers is, one, their comfort in small towns, which grows every year as they see the performance, but also understanding that they need to reconfigure their spaces sometimes to fit in non-traditional shopping centers like ours, versus it's a lot easier for them to go and backfill a 10,000 square foot box that was occupied by somebody else. But like seeing their willingness to, again, like transform their footprint and see the opportunity in small towns that 5 years ago a company like theirs would never really explore or even like put in that time, resources, and energy to even give it a try. Those types of tenants that are growing, that perform, and, you know, again, when you look 5-10 years down the road, you see the strength and the ability for them to still be there versus some that we may have today that may not be down the road. So does that answer your question enough?
No, it does. It does. Do you entertain mom and pops though? Like you mentioned, the major retailers. Okay.
Yeah, and so it's a core part too, and both in that ones that we inherit and ones that we put in. And a lot of our more mom and pop local tenants are restaurants, and we typically have one or two restaurants in every one of our centers. And sometimes they may have 3 locations in neighboring towns, but it goes back to really more of the combination of, if we're putting one in, not just restaurants, it could be a nail salon, it could be just a local business. It goes back to really understanding their ability to operate that business, their historical performance. Is this their first location? Are they moving, or is this their 3rd location? And what is it going to take to make them successful, both on a initial package of whether it's TI, free rent, what the rent they could pay, and that sort of thing. And so it's a healthy combination. You can't just do it with anybody, but at the same time, the ones that we feel confident about, that also we feel fit the need of that center and that community. One of the benefits that we have of our experience and scale is we can help educate them on even the process of getting that store open, right? So a lot of times we'll take over doing the actual work rather than giving them TI, because that's a whole endeavor that is really, overwhelming for a lot of people that may not be experienced in it and that sort of thing. And so we have the experience of knowing how to get that done in any small town across the country. And so those are really fun, rewarding experience to be part of. We just made a video about a property we have in Logan, Ohio. It'll come out soon, and it highlights one of the tenants there who called Hawk's Nest, but they make custom apparel for that whole county. So like the high schools, they also do like prom and homecoming wear and all that sort of stuff. And they're a big highlight of that video because we also moved them from an existing space to a bigger space to help them out with that process. And it's been a good, great back and forth relationship, and they're such a staple of that community. It's not a business that I ever would think that we would, go out to pursue by any means, but at the same time, like their integration with the fabric of that community is a perfect example of like the mom and pops that we like to work with and kind of fit the bill across really what we're trying to accomplish.
That's a great value add. I feel like a lot of small business owners just want to focus on what they do, and the lease negotiation or the TI is an afterthought. So the fact that you guys can step in and help them out with it is tremendous.